All right, today we are diving into a real head scratcher, a company called OpenDoor. Seriously, this stock has investors completely divided. Is it the future of how we buy and sell homes, or is it a fundamentally flawed business on the brink of collapse? Let's get into it. So here's how we're going to break this down. First, we'll lay out the central puzzle. Then, we'll look at the absolutely chaotic financials that got us here. We'll explore the bull case, the argument for a huge comeback, and then the bear case, which says this is all a trap. After that, we'll see how this division plays out in the market's valuation. And finally, we'll look ahead at what to watch for.
Okay, so what is the core issue here? Well, it's that OpenDoor is one of the most polarizing stocks out there right now. There is a deep, fundamental disagreement not just about its price, but about what kind of company it even is.
And this really gets to the heart of the puzzle. You've got the market, which seems to absolutely love the stock, bidding its valuation way above its competitors. But then you have the professionals, the Wall Street analysts who cover this company day in and day out, and they are overwhelmingly bearish. Their price targets suggest a total collapse is on the horizon. I mean, how can both of these things be true at the same time? To even begin to understand this, you have to look at the financials. And honestly, whiplash is the only word for it. The last few years have been an absolute roller coaster for OpenDoor's top line. So at its absolute peak in 2022, fueled by those historically low interest rates that created a total housing frenzy, OpenDoor's revenue soared to an incredible $15.6 billion. It felt like this company was an unstoppable juggernaut. But then, the Federal Reserve started hiking interest rates, and the housing market just slammed on the brakes. And as you can see, OpenDoor's revenue completely collapsed by nearly 2/3. This right here is the core risk of the iBuying model, buying homes directly from people for cash. It is incredibly sensitive to the health of the wider economy. But here's where the story gets really weird and kind of counterintuitive. If you look closely at the data, you'll spot this inverse relationship. Just as revenue was plummeting, the company was forced to get disciplined. They had to stop chasing growth at any cost and instead focus on making a profit on each and every home. And look what happened. Their gross margins actually improved a lot. It was a conscious choice, profitability over sheer volume.
And you can really see this discipline in their contribution margin. Now, this is a key number that basically shows if they're making money on each individual transaction. It swung from being deeply negative to positive. That's an improvement of about $500 million. It proves that, yes, they can make money on a per-house basis, even if the overall company is shrinking.
And this brings us right to the two competing stories that explain why this stock is so polarizing. On one hand, you have the turnaround story, a company that was forged in fire and is now emerging stronger and more resilient. On the other, you have the structural trap narrative, a flawed business model that just can't work in a normal, non-zero interest rate housing market.
All right, let's dig into the bull case. This is the argument for a major comeback. The people who believe in OpenDoor think the absolute worst is over, and a much stronger company is rising from the ashes.
So the bull argument really rests on three main pillars. First, that newfound financial discipline we just talked about. Second, a strategic pivot away from just flipping houses and towards higher margin services like title and mortgage. And third, a huge leadership shakeup that actually brought the original founders back to steer the ship.
And if you want to see conviction, look no further. While you see some executives selling shares, which, is often just automatic for tax reasons, look at this. Co-founder Eric Wu just placed a $3 million bet on his own company, buying stock on the open market with his own money.
Let me be clear, this is not just routine. Insiders might sell stock for a dozen different reasons, but they only buy for one. They think the stock is cheap and it's going up. A purchase of this size is a powerful, unambiguous signal that the people in charge believe the market is dead wrong about their company's future.
But of course, there's the other side, the bear case. And it argues that all this optimism overlooks some fundamental, maybe even fatal, flaws in the business. The bears see a company that's caught in a trap, and it might not be a trap of its own making.
The argument against OpenDoor is brutally simple. First, it has never, ever achieved sustained profitability by standard accounting rules, what we call GAAP profitability, not even in the best of times. And second, its entire business model is basically one giant leveraged bet on a housing market recovery that, let's be honest, is nowhere in sight. In fact, you don't have to look very far for evidence to support the bear case. Just look at the company's own forecast. They are telling investors to expect another sharp drop in revenue and a return to losses. That directly undermines the whole turnaround story and just highlights the crushing weight of their high fixed costs. Okay, so let's try to visualize this stark disagreement, this massive gap between the optimistic market, which is betting on the future, and the cautious analysts who are focused on the here and now. Now, if we look at how the market values the company versus its sales, a pretty common way to look at valuation, the gap is just stunning. The market is valuing every dollar of OpenDoor's revenue more than 3 times higher than its closest competitor, OfferPad. What that tells you is that investors are betting on a winner-take-most future, where OpenDoor is the only name that matters in the space. And yet, on the complete other side of this tug-of-war, you have the Wall Street analysts. Their average price target is just $1.45. To put that into perspective, that implies a potential 84% collapse from where the stock is trading today. A disconnect of this size between the market and the pros is, well, it's almost unheard of. So, with such a wildly divided verdict, what are the key signposts? What should investors be watching to figure out which side of this debate is actually right? What's going to prove the bulls or the bears correct? In the short term, it really boils down to 3 things. First, the very next earnings report on November 6th is critical. Second, any signal from the Federal Reserve that interest rate cuts are coming, which could thaw the frozen housing market. And third, we need to see tangible proof, not just talk, that the new leadership strategy is actually working. Looking out longer term, the story really hinges on a healthier, more normal housing market. It also depends on them successfully building out that real estate ecosystem beyond just buying and selling homes. And of course, the ultimate goal, the holy grail, proving the model can be consistently profitable, quarter after quarter after quarter. Ultimately, the company's future is tied to this mix of factors. As you can see, a huge chunk of it depends on a market recovery that is completely out of its control. But a very significant portion also rests on its own execution, its ability to innovate, manage its costs, and finally deliver on that promise of profitability. Which leaves us with the final question, and it really wraps up the entire debate for this fascinating, polarizing company. The answer will determine whether today's investors are getting in on the ground floor of the next big thing in real estate, or if they're just catching a falling knife.